listings lined up in a row. Josh brings the numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make your day. From the first hello to the closing sign, your journey to home is looking divine. Down, the numbers make sense. Jeb shows a vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make your day. From the first hello to the closing sign, your journey to home is looking divine.
Happy Wednesday. Welcome to another week of the Educated Homebuyer Live with Mr. Josh Lewis and myself, here to update you on what's happening with real estate, mortgage rates, the economy, all while having some fun and answering your questions. Josh, happy Wednesday.
Jeb, if somehow it wasn't a happy Wednesday, as soon as everyone heard that music, it became a happy Wednesday.
You know, people just love it. I see heads bobbing. You know, I can't see you at home, but I know heads are bobbing when that comes on. And hey, listen, we feel it. We feel
Jose
it.
925 cracked the cerveza. I see he's got the mugs punching on the emoji up there. I like it.
Hey, it's good stuff. Am I like just completely like lit up over here on this side?
It's very light. I feel
very
as though
bright.
like the sun has come up on the side of your room. I like it. It's
no,
fresh.
but the room is light. But am I like just stark white over here?
Not stark white, but it looks like from your lower right side, the sun is rising. And
it is. Yeah, the sun is, well, it's actually setting. It's getting darker earlier, and therefore you get more of it this time of the day. So soon enough, guys, it'll be dark when we're filming this, and that will suck. But
that will be awful.
We're not there yet. So, guys, the big news this week, after such a great week last week, is that mortgage rates have actually trended back up. We kind of saw a little bit of this last year, similar thing. And that's one reason we keep hammering into you guys. You can't afford, to some degree, to wait. If you're in a position to refinance, the deal makes sense. Ring the cash register. Waiting for lower rates oftentimes means waiting longer than you probably thought, because, you know, there's a lot of ideas and theories out there of where rates are headed. And as much as we want to believe them, and the reality is things are volatile. And with that, we're seeing rates move higher, Josh.
Yeah, and it's never fun. It's been a very, very big and pervasive theme. I think it's just because of the internet data, things being in your face. People feel like they have some sort of insider knowledge that a Fed cut is coming. We talk here every week about the Fed funds futures market, because that tells us what the market, people who are trading bonds on a daily basis and looking at this, are believing is going to happen. So I don't have any insider knowledge. You don't have any insider knowledge that is not already absorbed by the market. So if you've heard there's going to be a Fed cut, the market has heard everything you've heard and more, and already priced it into the market today. So absent new knowledge and new information driving them lower from here. So I've thrown it in here. So like right now we're at 97% odds, 92% odds, I think, of a cut next month, and then 70 to 73% cut. So like until you see the odds go up to 100% and until you see the odds for the December meeting go up to 85, 90, 95%, you're not going to see rates move lower. And then really at that, we've seen the vast majority of this all priced in. To see rates
Sure.
move lower, we got to start seeing next year's chart dip, and that's going to require either more negative news or positive news on the inflation front. And I think we're 3 to 4 months away from that, just because that's how long it's take the tariffs to sort of filter through the economy.
Good stuff. So we're going to talk about this in more detail. What I would like you guys to do is start putting your questions in the chat. If you have questions about real estate, about rates, about the market in general, start throwing those in. And this tonight, let us know your favorite sports team, your favorite football team. We want to know who you're rooting for in football this season. I'm a Panthers fan. I'm not a bandwagon guy. I'm not my father-in-law just jumps on any team who's winning. I'm a Panthers fan, and it sucks.
Well, some
quite
of the
frankly.
teams that he roots for are losing regularly, though.
Well, I mean that's fair, but here I am. We're 1-2. We're not contenders at the moment. So I hope that changes, but we're tried and true over here, fans. So let us know who you're rooting for. Put your questions in, and we'll answer them as we come out of looking at some charts. So, Josh, we always start with inventory. So a couple weeks ago, we actually saw inventory dip, and we thought there could be the potential for inventory to start moving down. Since then, we've seen inventory come back a little bit and then more or less flatlining. So this week we saw national increase of about 2,000 homes for sale, which is not a big increase by any means. But one thing that you're noticing is even though we've seen that small increase, the year-over-year number is contracting a little bit. Now we only have 20% more inventory than we did last year. That's a huge number. Don't get me wrong, but at one point this year we were over 30%. So, 20% still great to see. But as we move through the year, that number is going to continue to consolidate, and it's not going to be quite the spread that you see at the moment. Huntington Beach and Orange County. So Orange County, we actually are sitting at 4,549 homes, which is a decrease week over week of 1.67%. Huntington Beach, we're down to 265. That's a decrease of just less than 1% week over week. The peaks are in for both Orange County and Huntington Beach this year. At this point, inventory is likely going to continue moving down sideways. Best case, but the highs are probably in for this year. New listings, we're still seeing increase, where we were last year, not by any big spreads here. Just going to kind of go through these charts. Weekly pending sales also up compared to last year this time. And interest rates were actually a little bit lower this time than last year. And we actually have more pending sales right now. And it's largely due to that down move that we saw in mortgage rates. A lot of people got off the fence. I put a video out last Friday, which was a little different video than I had normally done in the past because I was walking and talking and just, it wasn't edited. It was just kind of me getting my thoughts out. And, I said in that video, Josh, one thing that I noticed, August was slow. And I thought, hey, listen, maybe this is the trend throughout the rest of the year. I was having buyers get offers accepted. My listings weren't really moving. And then all of a sudden, September hits, all my listings go under contract, and I'm multiple offer situation on every single offer we're putting out. I'm talking, we've got two people from the show right now I'm helping buy. Both of them, one had 13 offers. The other
I saw that seller multiple
6.
counter. I'm like, no, not again. I don't want that.
Yeah, so that's where we're at. A lot of activity out there at the moment, and we're seeing it largely due to that move down in rates. Price reductions, more or less moving sideways, sitting here at 41.5%. We're crossing over that number from 2022. So 2022 is going to have a higher price cut percentage this time of year than where we currently sit. But that number should continue to moderate as we get closer to the end of the year. Josh, I found this chart interesting. This came from a source that we look at quite often. I believe it was Calculated Risk. And the thing to note with this particular chart, this is demographic. This is age by population, or population by age rather. And this is 2024, the census estimates. And the two circles are things to note here. The circle that's 30 that's right in the middle of the screen, or the first blue circle you see, that's kind of the prime buying age of where we are the majority of people that are buying homes. And that's kind of where we are at the moment, right? A lot of those people are purchasing real estate today, first-time home buyers. But the thing to note is if you look to the left of that, those numbers trend down, right? So the people coming behind them, just less buyers, less in theory, less demand for housing just based on where the population is. And then if you look far to the right, that's boomers. Those are the people that are turning 80-ish. And that's when they typically start to sell real estate. That's when, start to sell. That's when they pass away, which then real estate gets passed along or sold or what have you.
Well, I mean,
Right.
yeah, it's not
Yeah, to
necessarily
some degree.
pass away. Like what Bill had mentioned in the article is 80 when they start seeing either passing away or other housing arrangements, moving in with family, moving into assisted living, any and all of that, where they might begin to sell homes. So
Right.
his take on this is that front end, we're going to see in about 4 to 5 years
Yep.
an increase in sales, and it will be pretty consistent for what we got about a 10, 12, 15-year time frame there. So until about 2040, it will have some impact in
Sure.
terms of increasing supply. And then he's also pointing out as we get past this hump in demand, you have a trough, but it's not really a trough. Like if we look back at it, this is last year, 2024. If we go to age 15, basically 15 to 35 is at the same level as the people on
Sure.
the other side of that little hump. So we absolutely had a spike. It was the worst time ever for COVID to happen in those ultra low interest rates because we were going to get a spike in demand regardless. So then we had an additional spike due to the ultra low interest rates, and that pushed home prices even higher. But if you look at that, basically from 46, 47, all the way down to 15, that population size is roughly the same. So you're not going to have an increase. You're not going to have a decrease that's really discernible other than a decrease relative to the last few years.
Yeah. But I guess the biggest thing here is that, inventory should start to increase in theory in the next 4 to 5 years because of aging demographic. Again, that's
So a small increase to supply, small decrease to demand. So
sure.
helpful, but not game changer.
No, it shouldn't be. Does it have the potential to be potential? I mean, in theory, it could if every one of those properties was sold, but that's probably not going to happen, right? Because it's passed along, people keep them, etc. But we'll move along from that. And this is Zillow's market heat index, basically just kind of showing where the market is at the moment. They believe currently, as of August, that we're kind of in this neutral market, right? Sellers have a slight advantage based on where that is, but more or less buyers and sellers are kind of in the middle with competing. I will say again, real estate is local, so depending on where you are, could be a stronger buyer's market. There's still markets out there where it's multiple offers, things are selling above the asking price. Again, the last 3 offers I've put in, we're getting another counter back today, and I already know that seller has an offer $75,000 higher than where we are. That's going to sell over the asking price by a considerable amount. And based on that purchase price, that's about 5%. I mean, it's a noticeable increase over the asking price of what that home's selling for.
We have a listener to the show that helped with a couple of refis in the past that they're engaged, looking to buy a bigger home to move into. And this is the 6th or 7th offer over the last 4 or 5 months. And they're not even, I mean, at this point, $899 offer, they just went in at $950. And
Sure.
we don't, the seller hasn't rushed back to accept it just yet. So we will see.
No, good stuff. And this is just another look at that same heat index. The areas with dark red are the ones that are seeing the most activity at the moment, whereas you start getting into the kind of that neutral, lighter color in the middle, pretty balanced. And then the blue markets are going to be your colder markets, if you will, where activity isn't nearly as robust as the red areas. All right, Josh, wealth. We're talking about America's wealth by generation. Looks like the baby boomers take the cake, so to speak.
Here's an important thing to look at here. People look at this, boomers, they get everything. The world was handed to them. The silent generation came before them, and they had it pretty good as well. And it's a much smaller slice of the pie. And it goes back to that demographic chart that Jeb was showing there, that many of them have left this earth, and the generation right behind them, the baby boomers, got a lot of their net worth. Gen X, as we're going to talk about just here in a second, is right behind the boomers. And in 20 years, when the boomers shuffle off this mortal coil, then that's all going to accrue largely to Gen X. So this is just the natural way of things. One of the things that you guys cannot see down there at the bottom, so I blew it up there for you. Data is net of mortgage debt. Boomers have owned their homes much longer, so they've appreciated much more, and they've paid those mortgages down. So we talk about, that forced savings in paying a mortgage down, long-term time horizon for letting appreciation and leverage do its thing. That is a large portion of that. I mean, some of it is 401ks and other things, inheritances from the silent generation. But when we look at this, whatever one of these generations you're in, eventually your generation is going to be that big slice of the pie too. So looking at this, Jeb, we're going to talk a lot about, you and I are going to talk till we're blue in the face about jobs, inflation, the economy, and what it does to mortgage rates and affordability. This one here, the goldish brownish line there shows construction, all employees in the construction industry. And then the other shows new housing units under construction. So about 2023, we saw a peaking and then a precipitous drop there in construction. Yet we haven't seen a drop in construction jobs. Normally, and that's fairly normal. If you look, the jobs, the brown line goes a little bit longer than the blue line before it dips. If we see that turn down, that's a fairly consistent canary in the coal mine that unemployment is going to go up, and we are likely to be on the verge of a recession or heading into a recession or already in one. This one here, Jeb, this was in the Financial Times. This term blows my mind, or just infuriates me, I would say, more than that people continue to use this, because stagflation was a term that was invented in the early 80s when we had incredibly high inflation and a very weak economy. So stagnant economy with inflation. So what we're going to see is we haven't seen a stagnant economy. It's not growing robustly like you would like to see over a long-term time horizon, 4 or 5% GDP growth. We're not seeing that, but we've been between 1 and 3.5% for the last 4 or 5 years pretty consistently. But what you're seeing here, we had a spike in inflation. We had a nice downward path on that, and then we got tariffs. So you can see that little peach bar on the right side shows Liberation Day. Shortly thereafter, inflation started trending back up. Trump loves him some tariffs. I don't know how he didn't realize this was going to sort of fly in the face of wanting to get inflation under control prices for households, control interest rates and affordability. But long way of saying, these things generally move together. You see inflation coming down as payrolls are decreasing. People have less money to spend. They're buying less stuff, so you don't have prices going up. So that's a fairly good signal to us that this inflation here is tariff-based inflation. It's not demand-based inflation because jobs growth has been down, but it's something that we will continue watching. This chart here, again, we talk about, we're not early in the quarter anymore. We're moving towards the end of it, and they are upwardly revising their figures to 3.3%, where the blue chip consensus is barely over 1%. Over 3% is well above anyone's expectations. If we're there, if that is true and correct, we are not anywhere near a recession. A
stagnant economy, yeah.
A stagnant economy. So we're just looking at things like, is anyone lying with any of this data? I don't think so. We just got a lot of mixed signals coming. This is a new one, Jeb. This is the churn model from the Chicago Fed. It is their nowcast that they created for the unemployment rate. And so they see it coming in at 4.26. I haven't read into the methodology to know what this flow consistent unemployment rate is. They've got it at 4.3. But that's where we're at right now. So they are projecting that when that data comes out, we're not seeing an uptick in the unemployment rate based off of their nowcast of what they're seeing. Trueflation picks up. This is long-term, a very high correlation to CPI inflation. A week ago it was at 2.29. Now it's down to 2.05. As you can see from this chart, it's very volatile. I would love if they would like smooth it out to like a 90-day moving average so we could kind of see a better trend. But it's been sideways between like 1.85 and 1.87 a year ago was probably the low of it. Actually, the low, it looks like what, 1.3, 1.4 down there, Jeb. But just really trending sideways and nowhere near that 2.8, 2.7 that we're seeing in the data that we're currently getting today.
Well, hold on, Judge. Let's go back two slides real quick because I have a question. So with this churn model, so this is a nowcast, but the months only go through June. So we got July, we got August, we got September data that can't be in there because, and so how's that a nowcast? I mean, I don't know that you know the answer, but
I do not know the answer because, as you know, well, yesterday morning we just had found out this thing even exists, and I haven't had time to dig into it. They have like 3 or 4 pages of their methodology of what it is, what it's telling you, and that should tell us why it goes back to June.
So if we're looking at June and we're now at September, and we churned up to 4.3 with the August data, is this behind? I mean, I guess we don't know the answer, but I mean, is it, if they updated this with September data, so to speak, would it be higher than 4.3? That's, I guess, the question. I don't know.
The $24 million question that we will attempt to answer next week after we've done our research.
All right. Good stuff.
We already went through that. So we've talked about this 92% chance of a cut next month. So what are we, 6 weeks? No, 5 weeks away from likely another cut. And then we have about 6 weeks, 5 weeks after that, 75% chance of another cut. So this is fully priced in. And if we somehow didn't get that cut in December, 85% chance that we get it in January. So when we're looking at this, it does project 2 more cuts, but this goes out through the end of 2026. 2 cuts priced in for next year, not heavily, but that would imply that you see a continued downward trend in interest rates. An article that I was unable to relocate this week, I should have done a better job of saving it, but someone had pointed out that when you go back to Fed cutting cycles, anytime a Fed cutting cycle does not coincide with a recession, when the economy is still, even if it's not hot, it's performing at an even level, you generally see rates stay the same or increase. So if we don't have a recession on the horizon, which some of the data that we just showed says it is not coming, then we're likely to see mortgage rates stay in the range where they're at right now. But as they say, time will tell. The chart shows that down channel is still intact, but we broke out of the bottom there, and an uptrend in a longer term trend line from the bottom showing an increasing rate held, and we are moving back up. So when we look at that, the green and the red line there, we haven't been able to get below that green line. If that had held and kind of moved back lower, that would have been positive. If the red line holds and moved back lower, that would be positive. If we give way on that red line, there's a very good chance that we move all the way up to the top greenish trend line there, which would not be good. So important levels that we're looking at there, 4.12, we're already above. 4.19 would be the next important one, and then a few above that. But it's hard to look at that right now and say we should be holding off, because I think the lower rates are coming. You seen anything there, Jeb, that tells you we should be expecting lower rates in the next few days?
No. The chart that I sent you this morning of my lines on the 10-year, I drew my own trend lines and what have you. I see an opportunity for higher for the 10-year to move higher. I don't like saying that. I hope that I'm wrong. But this is one of those weeks where we're going to get PCE. PCE is supposed to be higher than it has been previous months. I mean, if it were to come in even higher, while the Fed isn't, I guess, that concerned about inflation so much, because they have an idea of where the market is. They're kind of focusing on employment. I still think that's a negative for the bond market, and you could see rates move higher. So I just, if I were a betting man and I had an interest rate that I needed to lock right now, I would lock it before PCE, because I don't think that it's going to be, I don't think there's a huge benefit to the downside. I think that there's more of a risk to the upside.
You got to be careful when people have, they read into something. But Powell spoke yesterday, and he said, we have inflation data coming this week. We think headline inflation is going to be running at about 2.7%. Mm-hmm. That would be about 0.1 lower than the market is expecting for tomorrow. So if he had any sort of preview to that data and was tipping his hand there, he could have misspoke. He could have been guesstimating. Sure. It's not so far from the range that he has some monstrously low number. Jeb's right. If you get a hot number, you get 2.8, 2.9 tomorrow, it's going to be problematic. But if you get 2.7, you could see a little bit of relief. I mean, it's not going to cause rates to go a ton lower. But for all the people who were like, nah, Fed cut, I'm going to let it ride for another week or two and let this get lower. Most people are an eighth to a quarter higher than where we were at the time the Fed announced the cut.
All right. Moving along. Where are we at with rates, Josh?
So if you look at this, up about an eighth week over week. So we got the Fed cut last week. We're up about an eighth of a percent, and we've had what 5 trading days, and I think 3 were up and 2 were down, and it's taken us up about an eighth. Same over the last month, we're down about an eighth. So we were a quarter at the best, but 6.375 again, 25% down. 780 plus is what he's quoting there. If you fall into that category, 6.375 with 0 points is likely, and the FHA and VA, we're still getting most people under 6% on those, unless you have a much lower credit score.
All right, good stuff. So if you are currently under contract, looking for a second quote, interest rate wise, unsure about your lender, starting the pre-approval process, all of those things, the team here can help you out. You can use that link at the description of the video, or the one trolling, the one scrolling the bottom, jebsmith.net/start, and it'll get you in touch with Josh and the team, and they can guide you through that process. We'll also let me connect you with a real estate professional if you need one. Just connected 2 different people in the last couple of days. So
for those of you who pay attention to our pretty map there, it's much more red than it was previously. We've had
is that a political statement, Josh?
It is not a political statement. We can call it pink if it makes you guys happy. The pink states, which include, it would not be a political statement because you see California, Washington, well, New York is blue, but California and Washington are very, very pinkish red there. But the vast majority I shouldn't say by population, but by borrower population, we can cover about 90 to 95% of you that are looking to do something. And if not, we have some very good friends that can help in the other states. So reach out to us. Let's get you connected with someone, because on a daily basis, I get to hear crazy, dumb shit that you guys are told by lenders, and it upsets me. There are not, we've talked about it. It's 80-20. It is harder to find someone that is an expert and knows what they're doing than it is to bump into someone who just talks out their ass.
If you think we should include a 3 to 5 minute rant in every weekly live that Josh gets to rant about things that bug him for the previous week, from Wednesday when we quit the show to the following Wednesday, let me know, because we could do a 5-minute thing where Jeb just backs off and Josh gets to rant about all of the things he hears. I think it could be good. I hear it all anyway. I don't need to hear it for a second time.
Jeb,
but you guys haven't heard it.
We have someone here in the comments who I spoke to today, who was speaking to a big national lender who was telling him that they were waiting. They needed to hear back from HUD to see what was possible with their loan. Possibly the most straightforward loan situation I have ever seen. There's no curveballs, no weird stuff, no question marks. But someone told him, I'm waiting to hear back from HUD. Here's the kicker, Jeb. It got better. Said it's just taking a long time because Trump cut their budget. So it's really hard to get answers from HUD right now.
All right. Well, this is going to kind of go not hand in hand with that question, but I'm going to let you're going to rant a little bit. Raul says, any advantages with big industry lending leaders versus more smaller, mid-size lending companies, individuals, brokers like yourself, Josh?
The best way to get drilled in general is going to one of the large independent mortgage banks. They are known for having the highest cost structure, therefore the highest rates, the highest fees. Paradoxically, they have many really good loan officers. So we talk about it being important to have a good loan officer in a competitive environment. I look at this stuff and see what some of these independent mortgage banks, so we're not talking about like Chase, Wells Fargo. They are generally pretty middle of the road in terms of the terms they're going to offer you. And they have more along the lines of bank teller type loan officers. They're bank employees. You can get them in the branch. You can talk to them 9 to 5, Monday through Friday. I don't know, Jeb, do any of the big banks really have outside loan officers like they used to have 10 years ago?
No. Yeah. Everybody's in-house. Yeah.
There used to be independent people like me. And it would be good. We would have friendships with them.
Well, I mean, are there independent people?
Do you know an independent Wells Fargo LO? An independent Chase
independent,
LO? Like they're out dealing with realtors. Well, you can call them at 6 o'clock. You can get them on Saturday.
There are.
Okay.
There's a handful. There's a couple in Newport. There's some people here locally, but they're not plentiful.
So from that perspective, they don't go through the same training and education as an outside person. You'll get average to decent terms. And we're talking about most of our normal buyers here. If you're a private banker, you've got $1 million with them, different world. You're going to get a whole different level of service with the banks. But the independent mortgage banks, like what are we talking about? A New American Funding, a guaranteed rate, Fairway Independent, Cross Country Bank, banks that you've never heard of because you can't deposit with them. Again, they have
The rates are typically terrible.
many good loan officers with terrible interest rates.
Yeah.
So you're wanting to find sort of that Venn diagram, that intersection of a really good, experienced, knowledgeable loan officer that you have a rapport with, that you connect with, that also has access to really good rates. Now, I want to scream this because apparently, Jeb, over the last 3, 4, 5 years of doing this, we've told the people at home that the most important thing is that you make lots of calls and get the absolute rock bottom lowest quote. Because at least once a day, I talk to someone saying, I've made 14 calls. This is the best number I've got. Can you beat this? If you want to approach this like that, you're going to end up on the wrong side of unhappy. But to go back to the question was any advantage to the big ones? The person that you're working with is more important than where they work. And then they need to be able to get you competitive terms. And people in some channels are unable to do that. And they often happen to be the big national leading lenders that you're talking about.
All right, Josh. Leonardo is asking, hey, purchasing new construction, let's say it doesn't appraise with a VA loan. What are my options? Builder is stating on initial deposit may be needed up front to cover themselves first. So I don't understand that part. I think I do a little bit. So here's the thing is in order to have a binding contract, you have to put the deposit up front before appraisal's done, before home inspection's done. And I know there are people out there that say, hey, listen, I don't want to deposit my money until I know that this is the house that I want. Your deposit is refundable until contingencies are released, right? And so at least that's the way it works in California and most states that I'm aware of. Per the contract, you have a due diligence period. And until that due diligence period is expire. I mean, not expire until you sign off on that due diligence. Your deposit's not at risk. So in the case that the builder stating that you need to put a deposit up front, that would be accurate. That's typically, if I'm reading your question correctly. The second thing is, what happens if it doesn't appraise? Well, if it doesn't appraise with VA and you do, the Tidewater and the whole thing, and number just doesn't come in, you don't have to move forward. There's a VA amendatory clause that is signed with every VA offer that says, hey, listen, if the property doesn't appraise for the purchase price that you're purchasing that home, you don't have to buy it. And that shouldn't work any differently with new construction. Anything you want to add on that, Josh?
Leonardo, if you're still here, which I'm sure you are, tell us is it a big national builder or is it a local builder? The big national builders wouldn't pull this because they know and understand and regularly deal with VA financing. A VA loan is no less likely to appraise than any other type. There are Jeb and how the process works and thinks it's some sort of magical unicorn appraisal type that's likely to screw the seller. It is not. It is far and away the most flexible, best appraisal program there is out there. The VA doesn't have their own little silo of appraisers out there. These are appraisers that do all types of appraisals and happen to also accept assignments from the VA. If they want or they don't see the value, they don't get to bring it in low. They have to notify us ahead of time that they're going to bring it in low and do what Jeb referenced to Tidewater. They have to say, hey, Mr. Lender, Mr. and Mrs. Agent, we don't see the value here. Please provide any and all information you have that can lead to us bringing in the value at the sale price. So the difference there is they didn't put their name to a number and we have to go back and say, Mr. Appraiser, Mrs. Appraiser, you're dumb, you're wrong. This is what we think. They're saying, hey, help me. We're all on the same team here. So it just makes for a collaborative process. If that fails and they still come in with a low appraisal, they get taken out of the process entirely. And you do a reconsideration of value with the VA. And that goes to a staff appraiser at the VA who looks at it. And I have had them overrule appraisers. And I've had a friend who said they didn't overrule an appraiser. They looked at it and said, we think the value is accurate, but the veteran wants this home. We will guarantee the loan regardless. So again, the most flexible option there is out there. So it's most likely a smaller local builder who has no idea what they're talking about.
All right. Miscellaneous of the whatever has a question that we kind of answered, but just to clarify, I was about to ask how many future rate cuts are already priced in. I guess you answered it. So at the moment, there looks like two more for 2025. Looks like in October and probably again in December. And then as you look into 2026, there's a probability at the moment that there's two. So are all four of them completely priced into the market? I would say no, not with certainty, right? But as there becomes a little bit more certain, that's when you'll see, the 10-year or interest rates probably get a little bit ahead of those actual cuts. So you'll see rates come down. You'll see, there's a potential that you see the spread between the 10-year and the 30-year contract a little bit, consolidate a little bit prior to the actual cut, so that when the cut happens, you're not likely to see a big move in rates because it's already built into the market. So we'll continue. I mean, we talk about this weekly, guys, and we'll continue to update you, but it looks like the future does hold more rate cuts. I mean, let's be honest, last September, Josh, was the last Fed rate cut until this year. Was that right?
I don't
Or
know.
was there
I don't
another
remember
one?
the
I
exact
don't
month
remember
when they
either,
cut, but
but
that sounds about right because I was back east in September and that was when everything started going
yeah.
down. So I don't think they made any more cuts after that.
All right. At the beginning of the show, I asked you to put your teams in when it came to NFL, and nobody did it, but one person. And they came in and they said they're a Vikings fan since 1997, for better or worse. Hey, congratulations. If the Vikings have had some decent runs here recently, but just can't get to the finish line, man. Yeah, you got a good quarterback now, though. You got a hell of a your punter, he kind of screwed you guys the other night, but hey, whatever.
You got another one here. You got a Buffalo Bill.
A Buffalo again, another strong team recently. Just can't make it happen at the kind of like the was it the 90s, Josh, when they went like 0-3? Was that
3 years in a row? So Rob, those were the worst 3 years of Rob's life.
I can imagine that.
Think about that.
I remember those.
Over that 3 year
that
time
was Jim
frame,
Kelly. That was Jim Kelly days.
Pretty safe to say that if you make the Super Bowl 3 years in a row, you were probably the best team over that 3 year time frame, but they don't give rings for that.
They do not. But I do remember it well. I had an English teacher that was a lady, and she loved Jim Kelly, dude. Loved him. And just defeated every time, dude. Defeated when they didn't win. Anyhow, Marcus thanked us for help and valuable information. Appreciate you being here. Got a question, Josh. Somebody asking what I think about the Compass merger. So we don't really talk a lot about real estate on here, and I'm not going to get into depth on this, but Compass basically acquired Anywhere. Anywhere is a conglomerate, if you will. They're kind of a holding company of a bunch of smaller brokerages, not smaller, but Century 21, Coldwell Banker, Better Homes and Garden. Like a lot of the leading real estate companies have now been. This is not final. This is just it was a stock purchase. It still has to be approved, so on and so forth. So probably not going to even happen until 2026. But it essentially makes Compass, by the largest real estate company by far, 340 something thousand agents. What do I think of it? I think it has the potential to be a really bad deal for the buyer side, the consumer side, if they do decide to go with this whole private listing thing that Compass has wanted to do initially. Because if they do that, you no longer have this central MLS system, the central database of all the listings, right? If it kind of goes the way that they had originally talked about it, which basically means that if you're searching for property, you may have to, if you're not with one of those companies, there may be another site that you have to go to in order to see properties that they don't have under their umbrella, which is going to create somewhat of a nightmare for buyers out there.
Wasn't one of the original rallying cries when the internet was growing was that data wants to be free? Whether that's MP3s getting extricated from CDs and thrown out on Napster, to listing data originally was in books like the Yellow Pages that you had to go to your realtor's office and look through, and eventually gets on the internet where you can look at it anywhere. I don't think it's a genie that you can put back in the bottle as much as someone. I mean, if you can control data, it's a competitive advantage to you. So I understand why they would want to.
Yeah.
But let me ask you this from a different question, same question from a different angle. We just got the question from Raul. Hey, do I go with a big national leader lending leader. What about your realtor? Does it matter who they work for? Do I need someone from Century 21? I mean, many people probably don't know who Real Broker is, Jeb. It's a newer
Sure.
entry, even though they have scale.
We just hit 30,000 agents, so
Okay.
smaller, right? So Compass, assuming that merger goes through, will have 340 something thousand agents, so 10 times the company that I'm with. But obviously they've been around a lot longer, so on and so. I mean, there's a lot of things going into that. But does it matter where your agent works? No. I mean, I was an independent for 10 years. I've been at Remax. I've been at Coldwell Banker. I'm here. Does any of that matter? It matters who your agent is. That's what you're hiring, right? I mean, that agent is the brand. You just need to find creating skills, all of the things that you would want in an agent, regardless of where they work. So it doesn't matter if they're with Compass, Coldwell Banker, Real Broker, or mom and pop, shop down the street. Just find somebody you're comfortable with, and you feel like, communicates well, does what they're supposed to do, has a track record of doing it. That's what you want to go with. So.
And maybe again, just kind of double down on this. We answered that very differently between lender and realtor.
Sure.
From your perspective, why is it different? Why is it different when you're looking at a realtor versus a lender?
Because we don't necessarily, because we kind of run our own operation to some degree, right? I mean, the bigger brokerages, what's their whole push like for trying to get agents, right? Their push for trying to get agents that would benefit buyers is that they can share listings with one another before they come to the market. That would kind of be the advantage for a buyer side, right? Is, hey, if you're looking for something specific, I go into my office meeting, I mention it. Hey, somebody in my office might have it, or, we have this network that, of agents where we share a property, that sort of thing. That would be the advantage. Here's the thing. We have the same thing within Real, and I have the same thing with a lot of local agents here, Huntington, where, we all communicate. We're all friends. We're, with different companies, we talk about different things. And so you don't necessarily need to be with a bigger brokerage for that. The other side of the listing side is that, hey, they've got marketing. Hey, they've got all of these special, data and the ability to put your listing in front of, all of these eyeballs. And the reality is we can do that anywhere. Any agent can do that. It's all about money and putting your money out there for exposure. So at the end of the day, you don't need company. You need to find the right person, right? It's all about the right fit for you. And it could be any company, and you could be completely happy. It could be somebody you've heard of a million times. It could be somebody you've never heard of. And I'm not biased in any way, right? There's great agents at every brokerage out there.
And I would say the only reason it's different on the lending side is who you work for dictates the products and rates and terms that you have to offer.
Sure.
Good loan officers in every channel. It's just you might get a great loan officer that can't offer you great rates if you're in the wrong channel.
Sure. Yeah, absolutely. Question here from Raul again, just saying, do you need to be a veteran to assume a VA loan? And the answer is no, you do not have to be a veteran. In fact, I have one right now that's assumable loan. My client, her father was a veteran. He passed away. She was able to, take over the mortgage after he passed away, and it's being assumed by a non-veteran at the moment. Here's the thing. Assuming a VA loan, at least with Carrington, who is the mortgage servicer, looking to take somewhere around 90 to 120 days to make this happen. So you need a seller that's patient, and you need a buyer that's patient in order to make this process work.
Yeah. You're going to want to stab yourself in the face when you're done, but it's probably worth it for a
for a 2.75 rate. I think it's probably worth it. That's what they're getting. Here's a question saying, how many credit checks from applying to the end of having the deeds funded? How many credit checks do you need to do, Josh, for a borrower from the time they pre-approve to the end?
Let's look at it from this angle. The credit report is going to be good for 120 days to closing. So when we pull it, we have to close escrow within 120 days. But the credit check, there should not need to be any other credit checks, but they will do undisclosed debt monitoring, which means they're just doing soft pulls in the background. So no hard inquiries on you, but it's definitely going to be looking to make sure you didn't buy a Ferrari, run your credit card up, buy the appliances and furniture for your house before you move in and screw up your debt ratio.
Good stuff. Danny says dating the rate is turning into a long-term relationship. Yes, it is. All of those, date the rate, marry the property, date the rate type thing that was happening a couple years ago. Yeah, rates haven't gone down. We've talked so much crap on that phrase, and I wish we were wrong about it, but unfortunately rates have stayed higher.
I agree. I'm going to share something here, Jeb, that will give you a chuckle. Friend of the show, Barry Habib. This is a slide from one of his decks saying that marry the home, date the rate works. And to a degree it has, because we're looking, this goes back to middle of 2023. Rates shoot up. Okay. Those people who bought up at the high, they had a window here, 2 windows, didn't last very long, but 2 windows to refinance. They run up, people buy. An even bigger window last year where they dip. We had a dip earlier this year. We have another dip now. Now, are these monstrously different dips? Like if you had bought up here when the 10-year was at 5 and rates were at 7.5%, 8%, did you get a 4% rate? You absolutely didn't. And that's the problem, is a lot of people were telling people to expect that you were going to get back to some sort of magical COVID era rate, or even a 4.5% or 5% rate sometime soon. So it has worked. People have been able to refi into those dips, but a lot of people have missed because they also know that the Fed's going to cut next month. So they've been waiting.
All right, good stuff. So we've got Tombo Jumbo asking questions about compensation when selling homes. Here's the thing. As a real estate agent, I can't even really get into this because we can't really discuss compensation in what an average would be or whatever. So yeah, there's not really a good way to me explain that without probably getting put on the hot seat to some degree if someone were to find out. So I would say talk to a couple of different agents in your market. You're going to get a really good idea of what people are willing to do, and you'll be able to get an average based on that. But there's a big range out there in what people are willing to charge you, but there's also different services that come with whatever they're charging you, or the lack thereof, based on what their fee is. So just make sure you're comparing apples with apples when you're looking at those numbers. Josh, Leonardo came back and said the builder is Newmark Homes. So Newmark, somebody asked about Newmark not that long ago.
It may have been Leonardo.
Yeah. So I'm not aware of Newmark, so I can't really give you any information on, because you did ask if they were a big national builder, Josh, and so he came back and answered that. But
it sounds like regional, not that small, but not that big either. It's just they should have better understanding and knowledge of VA loans to not be saying to a veteran. It's just it's a very bad look to tell a veteran, hey, we'll entertain your VA benefit that you earned by serving the country, but you're going to have to jump through some additional hoops for us to protect us.
All right, good stuff. Tom Collins says, other than like and subscribe and share, how can a home buyer receiving your education provide support for y'all? We don't need support per se, but Josh, what would you say? How could they, I guess, support the show?
Bitcoin,
I guess support might
Bitcoin, Costco Gold bars, either are good.
No, there's a couple of things. I mean, you could share it with a friend. If you're in the process, you had a good process, refer somebody else to us. I mean, again, we help both on the mortgage and the real estate side, so we're able to guide you, whichever direction you're going. So again, if you find any value, the best thing to do is share us with a friend, subscribe, do all that stuff. I mean, again, we're not asking for anything monetarily from anyone. It's just, we're here to provide education, and we hope you guys find value in that and say, hey, listen, based on the value, that they provided, and, whatever, that's who. Good terms, right? I mean, you shouldn't come to us and get shitty terms and say, well, they provided me service, I got to go with. No, we should be competitive, and we are. So use this as a resource.
Jeb, this will humor and entertain those of you watching at home. I have someone who reached out from the show probably 4 or 5 years ago, and we have credit monitoring on all of our clients, including people who have checked in the past. It's like that undisclosed debt monitoring. It lets us know, hey, is someone looking? Are they in the market for a HELOC? Are they in the market for a mortgage? Or some of it's predictive as well. But one of these just popped up that after about 3 times of going through the cycle of getting pre-approved and backing out, we weren't the right fit, and I didn't know that she was ever going to buy. And now this is about the 4th time that I've got notified that about every 6 or 8 months she's going to buy a home again, and yet just doesn't do it. So I don't know what the lesson is for you guys at home, but I don't know that continuing to tease yourself every 6 months that you're going to do something and then not following through with it is the best thing. So
isn't that how that works?
Something like that.
For some?
I'm just saying, like, do or don't. Either say, hey, I'm a renter for now and I'll get serious about it in the future, but don't tease yourself by thinking every 6 months. Nothing changes all that big every 6 months. You know what I'm saying? So you just got to decide, are you in or are you out, and make it happen. Because over that same time frame, lots of people who have bought, and they, even if they bought at the high end, they refinance, they build up some equity. You got to do what is right for you. So I'm not saying that she should have absolutely done it, but she probably should stop torturing herself by
well, we both did. All right. So we got some people in here. 49ers fans, Josh. We got a 49ers fan.
No, we don't have a 49er fan. We have the strangest type of 49er fan, Heather in Inglewood, right? The home of the Rams.
Since 1990, that just shows
the home of the Rams, rooting for the
Chargers.
49ers and the Chargers, I guess.
But she, loyal since 1990. I can get behind that. Here's the thing is, I'm a Panthers fan, but locally I'll pull for the Chargers just because I kind of feel like I need a local team. But hey, listen, if you ask me who my team is, it's the Panthers.
The Chargers should still be in San Diego, happily.
They should be, and they've got actually a good team this year. So I'd like to see them do something. That'd be fun. Let's see, what else do we got?
I think we're running out of questions. We talked about football. We've answered all of the questions. We've clearly educated all of the home buyers out there in internet land, and they know what they need to know.
So we got another Niners fan here. It's even on his bank card. Look at that. I just got a Ridge wallet, Josh, a new one.
With a 49er logo on it?
Not a 49, with a Panthers logo. I kind of have an in. So I didn't pay for it,
But,
so I mean,
why did you
otherwise?
Why you went back to the old one? Why did you give up on this one? I like this one. It's tiny.
It is tiny, but I got two. I got two because, again, I have a contact.
I didn't hate the old one.
The one I have today, I have to show you when I get off the phone the new one. The new one's rad. Not the Panthers one, the other one I got. So, anyway, we're talking. You guys are just here, just admiring.
Two doofuses talk about wallets.
Hey, here's the thing: if you don't have a Ridge wallet, you should buy one. They're fantastic. I
love them.
I
new one or old one, they're both good. I like the old one. I love the new one.
There you go. All right. Can you touch on buyers who are trying to buy a house after filing bankruptcy? So, Josh, there are some rules depending on whether you're going conventional or government loans, FHA, VA. I'm assuming USDA probably falls in there somewhere as well. And they're different. FHA, I believe, is a year after chapter, 2 years after chapter
two from discharge.
Okay. And then conventional is
4. And those are chapter 7. Chapter 13 is going to be very different because 13 is a reorganization. You're actually paying back your debts. You can do an FHA while you're in a chapter 13. This will tell you we've been in a good economy too long that these don't come up often enough that this old man has them memorized. But I believe that you're 2 years on a 13 for Fannie Freddie, but don't quote me on that. We would have to look it up. I'm sure there's a loan officer watching somewhere going, "Hey, dummy, I know this one."
Yeah. So just in reference to that, Josh, after the bankruptcy is discharged and you're able to buy, are there any differences at that point in your loan versus somebody who hasn't filed bankruptcy, or is it exactly the same process?
It's going to be exactly the same. And your likelihood of getting an automated approval is going to largely be dictated by your credit score and how that file looks. Post bankruptcy, depending on what types of things were discharged, many of those creditors do a really, really bad job of updating the reporting the way that they should. So if you have gone through a bankruptcy, it is incredibly important that you work on cleaning up that reporting. Needs to show discharge through the bankruptcy, all of that stuff, because you can end up with things showing out there still having a balance. They'll just stop reporting. They won't continue to report that you owe them money, but they'll continue to show balances, ugly things in there. So again, we use a company called My Credit Guy. There are other reputable credit companies out there, but someone can walk you through how do we maximize your score. I've had people 2 years after a bankruptcy come back with a 740, 750 credit score.
Yep.
So you can do it. You just want to make sure if you need to exercise that option of filing bankruptcy, that once it's done, you have the discharge, that everything gets reported accurately and you're doing the right things to rebuild your credit afterwards. Some people go through the BK and go, "I ain't doing that again. I'm not getting in trouble." But if you don't use credit, you're not going to rebuild those scores.
All right, this is a question, Josh, we've never gotten on the show, and I applaud Ashley for asking it. Says, I've used my VA loan a few times. As you know, the funding fee after the first purchase increases. Is there ever a time when a veteran should consider a different type of loan?
Yeah, and this is the primary time when they should consider. So the way the VA looks at it is first time use is 2.15 funding fee if you're not exempt for a zero down. If you're putting 5 or 10% down, it goes down significantly. So if you're looking at doing zero down, there are no other zero down options. So I have veterans on subsequent use who will say, I just don't have any other options. We have to do this. And they pay that 3.3% funding fee. The best and most important thing is hopefully you've built up some equity and you're able to do a 5 or a 10% down, in which case the VA would still be the better option. But it's like anything else. Numbers never lie. We just got to run the numbers and go through it and see what it looks like.
Yeah, get a side-by-side comparison. Pisar says, I'm looking into doing a refinance as the rates go down. What is your opinion on buying down the rate? 690,000 at 7%. So Josh, what I would recommend to this person is to use that link scrolling the bottom of the screen there, jebsmith.net/start. Reach out to Mr. Lewis there, have a conversation, have him look at your numbers and tell you, where rates are today with no points, what it would look like with buying down points, and compare and contrast and see what you think is best for you. What would you add to that, Mr. Lewis?
Same thing when we said to the VA question, the numbers never lie. You got to pencil them out. I'm thinking that with a decent credit score, 699 at a $690,000 loan could do a lower and no cost refi without paying points and buying the rate down. That way you're capturing some of this benefit, get to 6.5, 6.375 without adding a bunch to your loan, and be in a position to do it again if 12, 24, 36 months from now we hit that recession and a 4.75 or a 5.25 becomes available.
Wow, 5.25. You said 4.75?
We've gone through the numbers here before, Jeb. It doesn't take all that much to get there. If you get to the high end of normal spreads at 2% and you get a 2.75 10-year, it's a 1.5% movement from where we're at right now. That has happened many, many times throughout the last 25 years. Absent government intervention and quantitative easing, people act like it would take some sort of bizarre or random miracle for it to happen. It wouldn't. It would take a really bad situation to get back to the low threes again. But to get you something in the high fours, low fives is well within the realm of possibility.
All right. Let's see. Robert says, Jeb, make an argument for telling a client at risk of losing their dream home due to interest rates and encouraging them to lock. Make an argument for telling a client at risk of losing their dream home due to interest rates.
Well, he follows up with a different assignment for me, and I just kind of try to address both of them. Make an argument why waiting would benefit because market shifting in lower interest direction with data to support. We've gone through these questions about a million times.
I do episodes on this all the time on my main channel. Why would you do it now? Why time in your life? A lot of things, right? You got job stability, your financial stability, relationship stability. Everybody gets caught up in the rates. The rate is important. But the rate is not everything. You got to look at the monthly payment that's associated with it and see how comfortable you are. A lot of people don't understand, like a 0.25% move in an interest rate, depending on what the median home price out there is like 400,000, give or take a little bit. A 0.25% move on that is going to be like 100 something bucks. I mean, it's not going to be this major deal that everybody is chalking it up to be. You need a sizable move to have a considerable difference. And the reality is you're probably not going to see that anytime soon. I mean, coming down from 7.25% to 6%, that's been a big move. But you know how long that's taken? A year? I mean, 9-10 months, something like that. So I don't think waiting is only the right thing. Is if you're just not comfortable, you can't qualify, maybe you're working on your credit, you're working on some things in order to make it happen, that's when waiting makes sense. I don't know.
There's even more things worth waiting for than the ones that you just mentioned. I mean, as simple as, hey, I'm going to be getting married, or I don't know what's happening with my relationship. I might be getting divorced. This girl or guy might be bailing out, and my situation's going to change. Where you feel really good about where you're at, but other things. Earlier in the year, I had someone in an industry that was heavily impacted by the possibility of DOGE budget cuts, and they put it off for 3 months. And they're like, okay, coast is clear. We can do this now. There's a million reasons why interest rates should not be the reason why we're waiting, unless you just flat out say, I cannot afford it unless I get to this level. And as Jeb said, we're not talking about the types of payment changes or drops where that should be the deciding factor.
No, agreed. So here's the thing, guys. We've been on for an hour. If you found any value, make sure you like and subscribe. Reach out to the team here if you need a real estate agent, want to talk interest rates, need a second quote, jebsmith.net/start. But until next week, buy right, borrow smart, build wealth. Adios.
Amigos.
See ya.